Fifth, the Brexit deadline is rapidly approaching, and a hard Brexit, okay, let's call it what it is. Now your eyes glaze over, but it could be a disaster. I go to Europe. This is what people talk about when I'm over there. Maybe it causes a freeze in European commerce, just as there's a dramatic decline in Chinese consumption, where they sell a lot of product. A specter is haunting Europe, the specter of a Brexit-induced depression. This is the Armageddon scenario that could potentially lead to the failure of major European banks and a total shutdown of credit. It wouldn't shock me. The European banks are trading as if they are in big trouble. Six, the trading floors were all alive with talk today that this decline reflects a belief that Bernie Sanders or Elizabeth Warren might win the election. Both senators make no secret of the fact that they want to crack down on capital. So we better get used to the fear that they instill among wealthy people who own lots of stocks. That could explain why the dividend stocks keep getting hit, right? Because even though the bond market competition is upside down, well, think about it. Makes sense. If investors expect the tax cycle on capital gains and dividend income, they'd be dumping them. That could happen. It's not going to happen unless the Democrats nominate one of the more left-wing candidates and then sweep the Senate next year. But maybe some managers are trying to price in that possibility. If so, we've got plenty more to fall. The seventh and final explanation, several large institutions might be shorting bonds, betting against them, and as bond prices keep rising, they're getting squeezed and could be about to go bust. Now, it may sound far-fetched, but we saw something similar in 1998 with the failure of long-term capital management, a hedge fund run by allegedly smart people who took some incredibly stupid risks that ended up doing tremendous damage to the market. Go read Confessions of a Street Addict if you want to know. So which is it? Well, for the moment, it doesn't matter, does it? Whatever the cause, we can't not ignore the bond market's behavior. It's too extreme. Of course, many of these negatives are reversible. Almost all of them are man-made and therefore can be reversed. They can be unmade. Right now, though, our stock market is handcuffed to the bond market. As long as that's the case, the momentum is with the bears, not the bulls. Even if the bears ultimately turn out to be wrong. Ultimately, it's a long time from now. In stocks and bonds, momentum matters. And while it can be irrational, it is wrong to ignore it. This market is now largely ruled by fear. I don't like being scared into anything when it comes to my money or yours. And remember, panic is not a strategy. Eventually, I believe the Cassandras will be proven wrong. I still think the economy has some strength to it, or at least strength enough to avoid a recession. But in the interim, I accept that being calm and patient has gone out of style. I want to be opportunistic and say the bond market's just plain wrong and there's plenty left to buy. The truth is, though, we've been selling for my charitable trust, which you can follow along at actionalertsplus.com. We just raised cash. The bottom line, I don't blame anyone for raising some cash here. My trust did. But it would be a big mistake to sell everything. You don't panic when the economy's hanging on. You wait for more of a decline. Remember, the S&P is still up 13%. The NASDAQ is up 17%. And once it comes down, then you can do some opportunistic buying.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.